But if you follow the playbook, you're actually investing in what the government wants you to invest in, and you can basically make a very good living and a very good return on your investment by basically following the tax code. So rather than looking at it as a limitation, you can look at it as an opportunity.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. Listen, if you're getting some good value from these conversations, do us a favor and do yourself a favor. Leave us that rating and review. We want to hear what you love about the show, but also get any honest feedback that helps the show work harder for your investing goals. Tell us the kind of guests you want to hear from, the kind of insights you're looking for, so we can make that happen for you. And if this is your first time listening, make sure you hit that subscribe button so you don't miss an episode. Now, today we have Richard Crouch. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmancapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmancapital.com and click on the Mastermind button today. Richard Crouch is the principal and chair of Woods Rogers. He is also the co-chair of the commercial real estate practice and has built his legal practice on the foundation of commercial real estate over the past 2 decades. Now, Richard has been recognized as a go-to lawyer for commercial real estate by Virginia Lawyers Weekly, Legal Elite by Virginia Business Magazine, Super Lawyers by Thomson Reuters, Top Lawyer by Coastal Virginia Magazine, and more accolades. With that said, let's welcome to the show, Richard Crouch.
Thank you so much. Glad to be here.
Absolutely. Richard, I went over your bio at a very high level. Why don't you take 2 minutes and fill in some of those gaps?
Sure. No, I appreciate that. I've actually, my area of practice is primarily commercial real estate. I do a lot of corporate work, usually business formations as part of a real estate deal. But I've been at it for about 2 decades now, and really enjoy it. Really enjoy a lot of the folks that I get to work with. Basically, if it touches on commercial real estate, we handle it. So as you'd expect, acquisitions, dispositions, refis, commercial leasing. Um, but we also get into more of the sophisticated areas, particularly for syndications, people that are trying to document a private placement, the operating agreements, all the corporate governance issues, how distributions are handled, and so on. But we also get into some of the more nuanced areas like tax credit deals for historic tax credits, qualified opportunity zones, LIHTC deals as well. So we have a pretty robust practice area and a great team that does it. I've been very fortunate because although I've been doing this for, like I said, about two decades plus, I was really blessed. And in hindsight, I realize how much to have very good mentors, 2 in particular. I had one that was very serious and was very good about teaching me the technical skills of being a transactional attorney and to keep my clients out of trouble. And then I had another mentor that taught me basically everything else. And I think about very often what a gift he was because he was very big picture, whereas I was the details guy. And he was very good at teaching me how to attract clients, retain clients, manage the client relationship, but also to always have an entrepreneurial hat as well. And it was a true blessing to have him in my life. We're still in very good touch. He no longer practices law now. He actually is invested in numerous deals, multiple buckets of revenue, which has given him financial freedom. So he teaches yoga in South Beach. He does Russian acrobatics and pretty much anything he wants to do. So not your typical legal path, but definitely has shown me the benefits of not only knowing the law, but also having a business-minded mindset.
I love it, man. So for 2 decades or close to 2 decades, you've been practicing, commercial real estate law in all facets from acquisitions, dispositions, leasing, refinances, syndications, tax credits, opportunity zones, etc. So you really do have kind of a wide range of knowledge when it comes to the different facets of real estate investing in the commercial sector. So I want to ask a question right now because, as we're recording this, the market has certainly shifted. A couple years ago, it was certainly a seller's market. You could pick and choose who you wanted to sell to at whatever price you and terms you thought were most appropriate. That's certainly shifted over the last, 6 to 12 months, maybe even up to 18 months or so at this point. Um, how does that shift from a legal standpoint? When you go from, maybe being a hot seller's market to more of a buyer's market, what does that look like differently from a legal standpoint?
Yeah, it's actually a great question, and it's a question I get fairly often because people know that 3 years ago, we practically had to turn away work because we were so busy. But now a lot of the syndications, which I would say are our bread and butter clients in terms of having the most comprehensive need for legal work, those are largely not active. So a lot of the transactions we're working, and largely because of interest rates and so on, and not being able to make the numbers work for a particular deal. So a lot of the clients we're representing now are sellers, not so much one or two syndication deals, but a lot of them are basically land deals right now where they're basically being rezoned for residential developments. Um, Otherwise, right now is a time where there's been a lot of housekeeping, not really the sexy big files that the big transactions that everybody wants to work on right now, but making sure that all their corporate documents are in order. If there are any amendments that need to be done to their operating agreements, to make sure that those are being done. And the most common phenomenon that we're seeing a lot, particularly for my clients that are heavily into office, is they're doing a lot of those extend and pretend loan extensions or loan modifications. And I anticipate probably there'll be a lot of 1+1+1 extensions that we see. Hopefully they'll get to a point where they can refinance comfortably, but we are helping them with that as well. And then I would say probably the most timely thing, and this actually really applies to the vast majority of our clients. It would actually apply to probably the vast majority of syndications in commercial real estate, is being aware of the Corporate Transparency Act. And so that's something where we're really pushing out awareness to clients. And just to give a quick summary of that, it is federal legislation. It has been enacted, and it's actually effective January 1st, 2004. So it is coming up very quickly. A lot of people don't seem to have it on their radar, or maybe they think it'll just sort of resolve itself, work itself out. But basically, there are additional reporting requirements, and this is driven by the U.S. Treasury Department and an agency called FinCEN. And basically, it requires all companies, and there are a few exemptions to this, but more often than not, companies are going to have to basically submit information to a federally maintained database. The acronym is BOSS. It's not yet up and running, but it's going to require that people that have formed entities such as limited liability companies enter a lot of the information that would be in their state filing, such as the principal office address, et cetera. But also, and this is, I think, probably where it's the most sensitive, is any owners, this would be any members in an LLC that own more than 25%, who have previously enjoyed a certain degree of anonymity in terms of people not knowing where their investments are going to actually have to report to this federal database. So again, that's owners over 25%. That'll also be your typical sponsors as well. They're going to have to report, and their name is going to be in this federal database. And then for folks that they call company applicants like myself, who basically have helped form these entities, I'm going to have to basically report to that as well. So it is pretty far reaching. And again, there are certain exemptions. For example, if somebody already does federal reporting for some other reason, like maybe a government contractor or something along those lines, they'll probably be exempt. But most of these commercial real estate deals for traditional syndications, at a minimum, you're going to have two people that have to report. And again, that would be the company applicant, the sponsor, and then if you have any owners that own more than 25%. So there are criminal and civil penalties for not timely reporting. But pretty much the time frame is if the company is already in existence as of today or as of December 31st, 2023, you will have 1 year to complete those reports and submit it to the database. But if the entity is formed after January 1st, 2024, you'll only have 90 days to submit all of that information. So hopefully for those of you that have attorneys, they've reached out to you. If not, it is something to definitely research and just make sure you're in compliance because again, you don't want to run into those penalties down the road. So that's another thing that in a relatively slow transactional market, we've been doing to also stay relevant and to keep clients informed.
I think that's a great point out. I'm glad you brought it up. So the Corporate Transparency Act, we'll make sure to put a link to that in our show notes. People can read up on it. But the things that jumped out is one, starting January 1st, 2024, you will have to file the information. You have to upload this information, understanding who's a part of these corporations. They're trying to understand more about the people behind it, the equity, some of those key elements. And you said that the penalties can be quite severe. So first of all, there are criminal and civil charges that could be filed against you. If you have a company that's been in existence, you have up to 1 year. But any new entity created in 2024 only has 90 days for
That's right.
completion of this paperwork. So that's certainly something that has to be on people's radar. Um, what do you like? For those folks who own assets right now and have not talked to their attorney, when should we do this? I mean, is this a part of our tax filing? Like, is this something that needs to be done? I know you said we have up to a year, but is this something that needs to be a priority to get done, during that time frame, or how would you recommend your clients approach it?
I would definitely get ahead of it because it is one of those things that although it will be a year basically for existing entities, deadlines like that tend to sneak up pretty quickly. So it is one of those things where reaching out to your attorney if they haven't reached out to you is a good idea. Hopefully they're familiar with it. Usually, if your attorney is your registered agent, hopefully they're going to be sending you some information with the annual renewal registrations that most people get. However, if you're your own registered agent, you're going to really have to take on a lot of that yourself. You may want to get your attorney to help guide you through it. If you have any questions on entering it into the BOSS um, system, but I think it's probably worthwhile just to go ahead and get ahead of it, just in case there are any hiccups. You don't want to be running up too closely to that deadline.
All right, and it's good to know. So definitely take that advice, reach out to your attorneys, and make sure you understand how you can keep yourself compliant here. One of the things that jumped out to me, you talked about kind of the syndications and working with a lot of those groups. We know that the market has been crazy, and as you mentioned in the office, some of these groups are just getting extensions. For someone who maybe has a deal that's not performing right now, what advice would you give them? I shouldn't say advice, not to, so let me take that back. For someone who has a deal that's not performing right now, should they be talking to their attorneys about their options? Should they be understanding, their documentation to make sure that they've disclosed certain things, or, what should they be doing in this current situation if they know that a deal they have is not performing as initially projected?
Yes, that's a great question, and yes, they should reach out to their attorneys. Hopefully, when they put the deal together, they did have a private placement memorandum. Hopefully, it did have all of the disclosures and disclaimers needed because, yeah, at a minimum, if there's certain disclosures that are contemplated under that paperwork, you want to make sure you satisfy that. But I would say, for optics' sake, if you have an underperforming asset, it makes sense to have as much ongoing dialogue and communication with your investors as possible to acknowledge the issue and to, although certain factors are probably beyond your control, to basically say, what is your ongoing plan for that? Because I think the worst thing to do is to play ostrich and stick your head in the sand because nothing gets cured by situations like that. But sometimes, even if you're in a bad situation, um, having that rapport and that level of trust with your investors can help salvage um, certain situations. I would also just as a prophylactic measure, take a look at the operating agreements that are in place because it may be that you have certain investors who are not satisfied with the fact they haven't gotten their preferred return in a number of months, um, and see what those exit strategies, if any, were at the time that the deal commenced to basically see if if an investor wants to get their money back, how do they do that? What are the triggers associated with that? Is there a right of first refusal? if they want to sell their interest back in terms of other members being able to buy that. How is the fair market value determined? Is there a formula? Do you have an accountant or some qualified individual determine what the purchase price is going to be? What are the notice requirements and things like that? Because there are two exit strategies or two avenues that you see. The ones where the deal goes well, where that's if the property's sold or refinances or somebody wants to do a 1031. And then you have the exit strategies where either you have an unforeseen event where you might have the death of a principal or bankruptcy, or you just have someone who wants to disassociate because it's not performing. And you need to have some pretty clear mechanisms for that. So that is one of those things where even if it's been 5 or 7 years, it's probably helpful to go back, see what those mechanisms are so that you can adequately prepare for that, whether you're going to trigger the purchase or you're afraid the investors might want to have their shares purchased, or they may want to buy your shares or membership interest. So that'd be another thing to look into. That'd be wise.
No, it's really good feedback there. And I think to your point, being proactive is just key, right? Understand your options, have the conversations with these investors, and no one's perfect, but if you can have a conversation, at least understand where they're coming from, maybe you can alleviate some of those concerns, maybe you can't. But having those conversations is going to be best for you in the short term and in the long term. Speaking of just protecting yourself as an investor, again, as you head into 2024 and you think about your clients, all the folks that you've worked with over the years, what are some things that surprise you that maybe many investors are doing that's a mistake or something you would not advise for them moving forward?
Yeah, there's some, and I can totally see why human nature would result in this, but you have people that are so excited about when the deal starts that a lot tends to be discounted or not properly memorialized. And sometimes you'll have somebody that does a traditional syndication and they'll claim an exemption under 506, but they won't do the necessary or the recommended filing after that. And that's one of those things that it's so, I'd say, quick and easy, or we do it often enough that it seems quick and easy to us, that it's worth it, because it's one of those things that when a deal is going well, nobody's going to point to any deficiencies in your registrations. But if a deal goes south, they're going to be looking for ways that you may have messed up, even if it was well intentioned or was something that the syndicator did not know about. So that's one area in terms of just doing the electronic filing that you can do to basically say we are claiming the 506 exemption. But other things are just making sure that the terms of the deal are very, very clearly laid out, particularly your waterfall distribution. Who gets paid when? Do you have a preferred return and then a pro rata allocation after that? And when does the return on capital occur? And have it very clearly delineated between income from operations versus income from a capital event. Make sure that's very clearly detailed. And then just what I was touching on before, if the investor and the syndicator decide to go their separate ways, to have very clear mechanisms for how that'll be resolved, and at a minimum have some sort of alternative dispute resolution mechanism in your operating agreement, because nobody wins when they go to court. Litigation is so expensive and people will pay six figures in attorney's fees and court costs before they blink. So sometimes having a clear avenue to resolve conflict on the front end before anything goes wrong is really, really key and just best practice for real estate investors and syndicators to follow.
No, I appreciate that information. I think it's just key, right? Follow the paperwork, don't cut corners. I know some folks maybe look at deals and ask the question to say, well, hey, maybe we can do a JV instead of a syndication. What's your perspective on that?
I have had some clients do it. Sometimes it's worked out well, sometimes it hasn't. Typically, you're going to have a scenario where there still is probably going to be one person that is taking the lead in that JV in terms of dealing with the lender, maybe handling the asset management, maybe even handling the property management as well. So they're going to have a lot of day-to-day control of everything. In many cases, we've represented a group that was part of that joint venture that was providing the bulk of the equity. And some of the critical things to them were to basically have certain events that they would have to approve no matter what, so that the right of the promoter or the sponsor was not absolute. So if they wanted to sell, refinance, file for bankruptcy, important things like that, our client had to approve of that. And there had to be at least a, if not a monthly budget, a quarterly budget submitted to the, we'll just kind of say the non-manager role in that, so that they basically knew that everything was congruent with the initial pro forma, and that they would have their eyes on that, and to have them approve expenses over a certain amount as well. We could say $25,000, $100,000, depending on the size of the project. But basically, give them enough information and basically rights to actually do something to save the project if they need to. And when I was referring to the extend and pretend, we've also had scenarios where there is an underperforming asset. It is a joint venture structure. And although most of the conversations with the lender are with the person other than my client, our client is still able to control that situation behind the scenes because they have approval rights where the primary lead can't do certain things unless they have our client's approval, which also affects the discussions with the lender. So those are just some of the key mechanisms to just retain control if you're not taking the lead yourself in a joint
Yeah,
venture.
what I heard you say was, when it comes to a JV, if you're going to be, active, or maybe you're not the main person running it, you still want to be able to have some control mechanisms in that relationship versus in a syndication as when you're an LP, you don't have that decision making ability, right? You're going to rely on whatever the operators are doing. So you don't have that chance to say, hey, I don't want to do that. I'm going to veto it. The JV may give you a little bit more power, a little bit more influence. But typically, you're gonna have to bring a little bit more to the table for that JV agreement as well, whether that's actual capital or experience, knowledge, know-how, whatever it is. Typically, there's a trade-off there that investors have to understand as well, right?
Yes, and your approval rights have to also be strong enough too, where if the other side of that joint venture has 2/3 of the membership interest, you don't want them to just basically run right over you. You want to have it certain scenarios that might have to be unanimous or might have to have 75% approval or things like that too. So you want at a minimum no less than 50-50 bargaining power when it comes to certain key decisions. Um, so it's just another thing I'd recommend.
No, great. I love that. So, Richard, you've been helping other people for almost 2 decades, and I know you've also become an investor yourself. Talk to me about that transition and kind of your journey being a real estate professional, working with so many investors in this industry, and then becoming an investor yourself.
No, I appreciate that. I think a large part of it was from my mentor, watching him. I think one thing that made him such a good attorney is being an attorney for him was not his end game. It was basically a stepping stone or an entree to the business side. And so really for my whole career, I've seen that. But yes, when we were talking before, I basically have taken the red pill in terms of seeing other ways to grow your wealth rather than just working countless hours in a given career that has limited tax benefits. So that was another thing that I saw. But yes, I've through working with clients, helping them structure transactions, seeing what pitfalls for them to avoid, what risks that we can mitigate, and what's worked well for their business plan. I got to a point where I felt comfortable actually using my own money in real estate investments, either by myself or collaborating with a few partners. And I'm fortunate in the aspect that where a lot of people have to start from scratch in terms of learning things and building up their network, I had already learned a lot. Maybe not as much on the business side, but in terms of structuring things, mitigating risks, how to document things that you shouldn't overlook. So that was certainly helpful. But I had also built up a pretty sizable network through just business development over the years. So basically, all of my contacts are in the commercial real estate world. And so if I ever have a need for a good CPA or a good broker or a good property manager, I know right away who to call. So I kind of came into real estate investing through somewhat of a backwards avenue, but it's definitely the most exciting time in my life to have my hands on tangible deals and to have multiple buckets of revenue, some of which are more active, but the real estate, I have an excellent property manager, so it is a bit more passive. I still have some asset manager roles that I myself have to do, but it's incredibly exciting to have multiple sources of revenue and to see things doing well, even in a challenging climate like this.
I think the big takeaway here is like you have the knowledge, right? You've already invested in a lot of the education from the day job. So to put that to work with your own personal portfolio just gives you more flexibility. On the flip side, it probably makes you even better at your day job because now you can see exactly what some of these investors are dealing with or going through and some of the challenges they may face. And that gives you, kind of a way to connect with them in a different capacity. And I would say you didn't get into the tax benefits, but being a full-time real estate professional, I push everyone to focus on becoming an investor because you get so many perks and so many benefits when you're in the industry, whether it's through relationships, whether it be through a tax designation. There's so many ways to take advantage of it. So if you're spending all your time and energy in this space right now, it is a really nice compliment to start building your own personal portfolio, whether that's active or passive. So lots of ways to get into it. I think with your knowledge and background, it makes sense for you to get on the active side and taking the red pill.
Yeah, it's certainly very true, and you're quite right. I mean, if the listeners have read the Cash Flow Quadrant by Robert Kiyosaki, he talks about the four areas where you can be an E, an employee, an S, which is definitely what I am as a private practice attorney, B for business, and then I for investor. And I'm definitely aspiring to be in that I quadrant because you're right. There are a lot more tax advantages to that I can't currently. I can avail myself to some, but in terms of carrying forward losses and things like that, applying it to my taxable income, I'm somewhat limited until I'm a full-blown commercial real estate professional. And so that is something that I do constantly have my eye on. But yes, it's an excellent reason to invest into commercial real estate. And there's a mindset. I think I've heard it through Kiyosaki as well as Tom Wheelwright, where they talk about how the government has given you a playbook for what to invest in. And one of the areas happens to be housing, multifamily, and so on. So there are tax advantages, tax programs to assist you with that. And they have other things like investing in oil and things like that. But if you follow the playbook, you're actually investing in what the government wants you to invest in. And you can basically make a very good living and a very good return on your investment by basically following the tax code. So rather than looking at it as a limitation, you can look at it as an opportunity.
It's a great way to put it. I appreciate that one. For our listeners who want to reach out to you, the best way to do that, you've got your email address, richard.crouch@wrvblaw.com. They can also go to the website, wrvblaw.com. But maybe you have a question about what questions you should be asking. So if I'm looking for an attorney, maybe it's a fit for you, Richard. Maybe it's not. Regardless, what questions should I be asking to see if this attorney is going to be the right one for my needs?
The first thing that I would look at, and it may not sound as important as you would think, but it would help if you have an attorney that does have some real estate investment experience, because they can draft documents very artfully, but if they truly understand the business and the returns that need to be achieved, they can look at things like waterfall distributions and basically say, yes, this makes sense. This achieves what the parties intend. If you have somebody who maybe did very well in law school but doesn't have much of a business background, it can limit their ability to be an effective attorney as well as to focus on the most important issues. So I think that's probably one of the most important things, but I would also not be shy from talking to your attorney about budgets, getting a feel for what's involved. I will say when with some of my more sophisticated clients, it's not really an issue because particularly if they're doing a CMBS loan, they know that there are a lot of moving pieces, there are a lot of deliverables, and they're going to need a lot of assistance. But if you're fairly new to the process, it's good to have that dialogue. And what we do for clients that are newer sponsors or newer syndicators, we'll send them a flow chart that basically gives them a good snapshot of everything that they're likely to encounter in terms of having to get certain things to the lender as well as doing their own due diligence review so that they can truly see all the things that are involved. And then in addition to that, when we send them our engagement letter, we'll basically have an itemized list that largely covers those same areas, but gives our best estimate as to what those various sections are likely to cost for a typical deal. And that way there's less sticker shock because no one is going to ever tell you, I love how affordable my attorney is, or they're so inexpensive. Um, but if you know what's involved, it'll be less of a shock to the system. And the last thing I would say is particularly the more you get into more complex, sophisticated deals, uh, I wouldn't be in a hurry to race to the cheapest attorney in town. And that may sound counterintuitive because, like all providers, you kind of want to squeeze where you can, work out the best deal for your bottom line. But the more you do that, the more of a risk you run into somebody who might not have that practice area in their wheelhouse or may not have enough experience to represent you well and to keep you out of trouble. So that's also just something to keep in mind. I think it is true that you get what you pay for. So it's another thing to be mindful of.
No, I appreciate that. I think it's really good insights, especially understanding the process, knowing what to look for in an attorney, looking for someone who has that experience as an investor, and then obviously someone who has done those kind of deals before and have seen different deal structures. That's going to make it a little bit easier if they're familiar and knowledgeable about what it is you're trying to accomplish, as opposed to someone who maybe can do it technically, but doesn't have that firsthand experience themselves, or it's not something that the practice typically handles. So really good insights. Again, if you want to check out Richard, go to his website, wrvblaw.com. Richard, we're going to go to our round of insights. Are you ready?
Yes.
Give me a failure or an apparent failure that sets you up for later success.
I think earlier on, probably when I was a senior associate to a young partner, I really had the mindset that I could do everything myself. Not so much in real estate investing, but in my own practice. And only through time did I realize that there was a way to grow younger, less experienced attorneys and basically leverage those resources. And by doing so, it would really pay dividends to me in terms of being able to grow my practice. So I think building up that level of trust where you could rely on other people and then learn to somewhat duplicate yourself in terms of work product and increase responsiveness, increase turnaround, and so on. And it's something I just discovered later in my practice, and I wish I had discovered it sooner, because once you grow a big book of business, in our own firm, we tend to get compensated very well, rather than if you're simply trying to do all the work yourself. And then one other thing that's in the same area is, even if you're incredibly busy and business is good, it's always important to stay visible and to stay top of mind. I mean, in my own personal world, you can be the best attorney there is in town, but if people aren't seeing you regularly, even if they like you, they're not necessarily thinking of you to reach out to have you handle a certain deal. And I would imagine the same logic probably applies in the business world in terms of opportunities to invest, or if you're a broker, for opportunities for you to list a property or to get involved in some other way. So maintaining visibility, even when times are good, and that can be like speaking on a podcast, drafting an article, pushing that out, having a newsletter, or just doing some more live speaking engagements too. And that's one of those things, we get so busy. I've been as guilty of this as anybody, but I think it's basically staying relevant is just one of the most important things we can do.
Give me a digital or mobile resource you recommend for yourself or your clients.
I don't use this for the practice of law, but if I do want to learn something new, particularly from the business side of commercial real estate, or there may be some tax nuance that I want to explore more for commercial real estate, I do actually use ChatGPT. I know it's getting a lot of press right now. I don't use that though as my only resource. I just use it as a starting point because I think it does succinctly give you an overview, and then you can drill down more deeply just through using a typical search engine. But that's probably one that I use more recently these days for that purpose.
Give me the book you've recommended or gifted the most in the last year.
I actually I laugh because it's tax-free wealth, and that the person the CPA Tom Wheelwright that wrote it. I was having lunch with a client, and I mentioned that I was reading a book called Tax-Free Wealth, and he just started laughing because he's thinking, "What a boring book! Why would you even suggest that?" But I had to tell him it is fascinating, and it's just like what I was saying before in terms of giving you a playbook for things to invest in, particularly in commercial real estate. it's incredibly valuable. And so that, and then there's a more legally bent one called Loopholes in Commercial Real Estate. That's written by Garrett Sutton. It's a longer book. It's a longer read, but it still has a lot of valuable information in it.
Give me a daily habit that helps you stay focused on your goals.
I would say personally, fitness is very important. I do a lot of running. My girlfriend and I do a lot of, there's a group called Team Hoyt where we push kids with special needs in racing chairs for half marathons, full marathons, 10Ks. And it's just one of those things that helps for longevity, but also gives a deeper meaning to just the everyday. So I enjoy exercise because I think it also enhances mental clarity. And from a mental health standpoint, I think it's also valuable to journal, not every day, but if there's some issue you're dealing with or struggling with, sometimes it does help to write that down, because it's amazing the therapeutic value that can have, where some of these stress factors, and it can be anything. It could be something in my world. It could be something in terms of meeting your investors' returns, things like that. It may give you some clarity as to how to solve that problem, but it'll also minimize the anxiety and the frequency that those stressful thoughts creep into your mind if you can write it down, and then move on to the next thing. So those are personal things that I do. And then professionally, staying organized, not procrastinating, organizing both myself and my clients definitely has been successful in terms of keeping them not only aware of upcoming deadlines, but what some of the action items are or open issues are. Because if you're not communicating well and often with the client, sometimes they'll think they're waiting on you, or you'll think you're waiting on them. And to just have that specifically itemized list makes it crystal clear to everybody, and everybody's on the same page. So those are things basically on a daily basis that I do.
All right, give me your number one advice for commercial real estate investing.
I would say one of the most difficult things for people to do is to acknowledge what they don't know, or to admit what they don't know. So some of my favorite clients to work with are either ones that are pretty sophisticated, they know the drill, I ask them for something, they get it to me right away, or ones that are pretty new to the process, but they acknowledge that they have a lot to learn. Those are the easiest folks to work with. The ones that are more challenging are the ones that don't necessarily have a lot of knowledge and experience, but definitely don't want to admit that, and will double down over and over again. And those deals end up taking longer, costing more, etc. So admitting what you don't know, surrounding yourself by important people, knowing that if you may have a deficiency of knowledge in a certain area, having good advisors, like a good CPA, good attorney, good loan officer, mortgage broker, because it really is a team approach. Oh, and I left out having a good mentor as well, because you're going to make mistakes, and that's how you become better at business. But there's almost a guarantee that if you find a mentor whose opinion you value and who you trust, they've made a lot of those mistakes, and they may be able to preempt you from making some of those same mistakes through their advice.
It's great advice there. All right. We're going to lighten the mood, all right? You are in the Virginia area, Norfolk, Virginia, to be more specific. Give me your favorite place to grab a bite to eat.
There is a place that has been there for decades. And so I work in Norfolk. I'm from Virginia Beach. I go to Virginia Beach a lot. There's a place that's right on the ocean front. You can honestly leave your meal, go walk on the boardwalk. But it's called Il Giardino's, and it's an Italian restaurant. The ambiance is amazing. The music is fantastic. The food and the service are fantastic. I think they train their waiters every day as to what all the ingredients are, how it's prepared, and so on. And you will basically feel like you have a special experience every time you go there. And I have certainly never been disappointed. So we try to eat there every time we're at the oceanfront.
Do they have like a live piano?
They absolutely do.
So
have you been there?
We've been there, and we had an amazing time. When I see her later, I'll bring this up to her. But I remember it, and I think she made a request for some Stevie Wonder song, and they played it. And we could never remember the name of the place though. So I'm glad you just told me. So we'll have to put that, keep that in mind the next time we're out in Virginia.
And
Beach.
he has that piano player has quite the lexicon, because I asked him to play, I think maybe I'm Amazed. He knew it and played it and sung it, and my girlfriend was just eating it up.
That's awesome. That's awesome. My wife's gonna be super excited to hear that. So I'll make sure we put that on the list. And this is one I've actually been to. I remember the meal was great, but the ambiance itself was. And back when we went, I remember too, like that was I think I had just graduated college. So like we ate, everywhere was super inexpensive. And like that was the one nice meal we afforded
Oh
ourselves
yeah.
on that
Yeah,
trip. So
it's not cheap. It's not cheap, but
yeah, yeah.
it's fairly priced, I think, for what it is.
Yeah, yeah. Well, anyway, listen, Richard, great information, man. You gave us a lot of good things to think about. For those who were not aware, I think this is a great and timely conversation about the Corporate Transparency Act to make sure you're having those conversations with your attorneys or your registered agent to get that paperwork filed. We certainly don't want to see any criminal or civil action against us over some paperwork. So please make sure you follow up and understand what your obligations are there. But I love the way you talked about just how to protect ourselves where there's opportunities, making sure we're proactive in our conversations with our investors, for those of us who are in syndications, and just making sure that we communicate. The more we communicate, the easier it's going to be to figure out what those solutions are. And we talked about trying to find an attorney that we want to work with. Find someone who is an investor themselves. Find someone who has a lot of experience working with investors, doing the kind of deal structures that you're looking for, because they're going to be able to help you navigate that landscape better than someone who's unfamiliar. So, really good information. Again, if you want to reach out to Richard, his email is richard.crouch@wrvblaw.com. You can also go to the website, wrvblaw.com. And then Richard's going to give out his phone number, which I normally wouldn't do, but Richard's going to give out his phone number. If you want to reach him, you can reach him at 757-353-0969. Richard, I want to thank you again for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.
All right. Thank you so much.